what really is going to move the price. The change in information leads to a change in the perception of the company, and it always comes down back to psychology. More dopamine is released leading up to the chocolate cake than when you actually get the chocolate cake.
You can actually map out the dopamine surge in our brain, and it looks similar to like how certain stock prices look. Company will drop banger profits. If investors actually expect even more profits, prices can actually fall. Dopamine works in the same way. It's about relative surprise, not results. A company could be making profit and the stock price doesn't really move.
That's really what moves the stock price. It's not just because they made profit, you know. Hi guys, my name is Matthew Preston and welcome to the Limitless podcast. Joining us as always is your co-host, Thaon Simms. Hail out the people, Thaon.
Hey guys, what's up?
And today we will be talking about the secret of the universe. What moves stock prices, right? I know that this is it's like an age-old debate. Whenever you get into investing or something, like people are always, saying, okay, this moves stock prices. And they're like, no, this moves stock prices, So I think it's been something that, it's always important, I guess, think about. Like, I even kind of have to sometimes remind myself, when doing this, reading this, doing this analysis, I have to always kind of go back and say, okay, what really is going to move the price? Does this, if I think this thing is going to move the price, what's the likelihood of this happening? What's the likelihood that I think it will move it by this amount? And, you always have to ask yourself the hard questions, How are you feeling about this one, Thaon?
Pretty good. I agree. I think it's very necessary to know what moves a stock price because, it's multifactorial, of course, right? I always think of investing. Meaning there's many factors, multiple factors. So there are multiple things that influence a stock price. So yes, there are factors that move it, and we'll go into all of them, of course, in the episode. And if you guys like this kind of episode where it's a bit more nuanced and so on, just drop a like, right? Hit a comment down below. Tell us what are the things you guys think move stock prices on the JSE, Jamaica Stock Exchange. What are the number like top 2 things, and we'll go into them. But something you touched on a while ago is also there actually, for me, there are levels to it too, because certain things will move stock prices more than certain things. And 10 years ago certain things would have moved stock prices, and now they don't move stock prices as much or any at all. So it's evolutionary. So I think it's a good episode to talk about just the things that generally will move stock prices, and maybe we can rank them. But I'd love to see you guys rank them in the comments down below. Let's get into it. Preston.
Yeah. So
yeah, age-old debate, as you say. What moves the stock price?
So okay, for me, I was trying to kind of just I guess condense it. So I was like, okay, at the core of it, there was a principle, or there's a way that an investor that I learned from, he phrased something really nicely. I've been, using it, and I'm going to big him up. Chris Camillo. He spoke about the concept of information and reaching information parity. So how I view it is that, say there's a company, I don't know, what's like a company that everybody loves right now?
Loves?
Transjam?
Yeah, why not?
I think Transjam, yeah. So say there was some sort of information that you learned about Transjam, right? And you were one of the first people to learn about it because you did like a lot of research. You were maybe reading into articles, on like, oh, they have some debt in Singapore and maybe there's something there or something like that. You're maybe on the ground doing some research, something like that, right? You're trying to do is discover some sort of game-changing information that not everybody knows, right? And there is almost like a process as the information eventually, becomes more public and more people know. It's almost like a process of it reaching to the point where almost everyone knows it. And then that's what you call information parity, because like everybody is equal. Everybody knows the thing. So initially you and maybe a few other people were the only ones that knew it. And then now everybody knows it. Right? And so I think that's the core thing that with the going back to this, what moves stock prices, it does start with some sort of information. But then the information, or usually there's like a change in information. So something was away and then there was a change. Something is no longer that way. So the company used to run this way. Something changed in the company. So they got some new contract. They won something. They lost something. So it could be good things. It could be bad things, right? But there's a change in the information that's out there. The change in information leads to a change in the perception of the company. So it's almost like, okay, you looked at TransJam. I don't know what price TransJam is today. TransJam is $4.03, right? You look at TransJam and you're like, hey, it's a $4 stock, or the market is saying it's a $4 stock. But say some news were to come out like, oh, they're buying the North-South Highway, they're buying this highway in some other company, or some other country, and that information coming out could change the perception of the value of the company. So someone looking at it today saying it's a $4 stock, the perception or their view of the company has changed. They no longer think it's worth $4. They could either think it's worth $3, or maybe they think it's worth $5 or $6 or $10 or $1, whatever, right? And then the change in the perception or the change in the view of the company leads to a change in the behavior around the company. So basically it's like, okay, it has to go back to like supply and demand. So it's like, okay, people, because like say for example it was good news, so good information comes out, causes a change in the perception of the company, that people view it more positively. That means that people that own the shares either don't want to sell, or maybe they'd have to sell. They'd only sell if it's a much higher price. They're like, yo, I'm not selling this stock for $4. I think it's worth $5. I'm only selling it at $5. So you're going to have less sellers. And then you can also have people who don't own shares, or maybe people who don't own as many shares. They then, because the information has come out, their perception has changed. They now want more of the shares. They're like, hey, that company that I thought was a $4 stock, I think it's a $5 stock, or I think it's a $6 stock. So I'm willing to buy at $5. So the change in the information leads to a change in your perception, will lead to a change in the behavior. And so because it's like, a mixture between supply and demand, if there's a lot more people wanting something and there's, not that many people wanting to sell it, the price is going to go up. And so at the core of it, I basically just tie it down to those three things. It's the information, the perception, and then the behavior.
True.
I don't know what you think about
that. I agree. No, it's the behavior that actually moves the price, because stock prices move when the balance. So, you saying TransJam, right? You're giving the example of TransJam staying at a steady price, because today it's like $4. Let's say it's just trading at $4. But stock prices can only move when the balance of either eager buyers versus eager sellers shifts. And you were talking about the reasons why it would shift. So behavior changes based on the information that you have, based on your perception of it. And that leads to different actions. So how I think of the market, and the simplest version of how I think of the market is like coronation market, right? At any time, any moment, there's a queue of buy offers. You could be selling lettuce or tomato or cabbage or pumpkin or whatever. There's a queue of buy orders, and a queue of sell orders. And a queue is just like a line or a list or so on, right? And price changes only when a trade happens at a new level, because someone is willing to pay more, or someone's willing to accept less. Like, let's say I'm selling the tomatoes. I'm willing to either accept less for the tomatoes, so the price changes, or somebody else is willing to pay more than the $4 per pound for tomato. Obviously not that, but than the last trade. And that's how prices change. So more buyers than sellers really means just more aggressive orders on one side at the current price. That's all it really means. So it's more, it's as you boiled it down to supply and demand. As that demand increases, and if supply either stays the same or lessens, or doesn't go up in the same amount that the demand goes up in. So if I don't get a ton more tomatoes to feed into the demand of tomatoes, and there's such an excessive demand, everybody wants tomatoes, everybody opening up a salad shop and a burger shop and this and that, and they need tomatoes. And yes, I can get more tomatoes, but if I can't feed into that supply, into that demand, if a lot of people want to buy it, the price, it will go up. Inevitably it will go up. So that's how I like to think of stocks too, because I just think of stocks as also tomatoes. It's just another asset, and people want it for different reasons, and the price will fluctuate for different reasons and so on. But the same way you're thinking about information parity leading into a change in perception, leading to the action, and the action is what changes the stock prices. But it all comes from there. So,
and it always comes down back to psychology.
Exactly.
Yeah.
Exactly.
And I think some other characteristics that I was looking at was there's also, you can factor in the intensity of all of these. So for example, say you could look at it like, think about like if you're someone who goes to the gym. It's like if you are lifting up a muscle, if you're trying to strain your biceps, you're trying to do the bicep curls, if you're doing 10 pounds versus 50 pounds, the 50 pounds is going to cause more stress. So it goes the same way if it's positive or negative news with like a company or an asset. So it's like, okay, say, I guess Wigton is a good example. Last year, they won the 50 megawatt. So Wigton Wind Farm, they're basically a public company. They were just...
Well, you're talking about one of the factors now. That sounds like news and the narrative.
I mean, to me, news, I tied this into the information. It's just the information, whatever different sources. So whether it's the article, the paper. Okay. But I was thinking intensity and magnitude of any of the factors that I mentioned. So, for example, I was saying about with the Wigton. So Wigton Wind Farm, public company, they had 3 wind farms. I think were producing maybe 60 or something megawatts of energy, which is a unit of energy, and they would sell it to JPS. They'd make money from that. They won a bid, or they won the ability to be able to basically build additional 50 megawatts of solar, or 50 megawatts of solar, because they didn't have solar before. So I think the magnitude is important there, because the stock price went from, the year before it was below $1, it went up to like $1.50. But I think the key part there is okay, they had say 60 megawatts before, so they won the additional 50 megawatts. That's 80% increase. If they had won a 200 megawatt bid, I think the price would have flown up even more, versus if they had just won a 10 megawatt. So it goes back to the same, whatever information, perception, behavior, there's also the intensity or the magnitude. So if someone wins a contract that is larger, or the information, basically the perception, people are going to view it much more positively. They think that, okay, if it's something that also is in the paper more, so it's not just in a single paper that only 100 people read, it's something that it's in a very public paper that millions of people across the world read, the magnitude of that is going to cause a greater effect, Yeah. And I even thought about it in terms of trying it back to the same weight or gym analogy, where there's also the speed at which it comes out. Because think about it, when you're lifting up a weight, to lift up a 10 pound, you just do it quickly. That's not that hard. But if you're doing it very slowly, you're going from the bottom and you're going up for 10, 20 seconds to do a single weight, that's going to be hard. Yeah. So there's also, I was thinking about the intensity with the same stuff we're saying, where it's okay, if it comes out suddenly versus it's kind of slowly creeping up. Okay, they're telling you about this teeny part and this part and this part, versus out of the blue, bam, just announce it, versus, okay, they give you a step by step by step. It's almost kind of,
because you can go from rumors to medicine things on social media to headlines, and and Gleaner articles and things like that, and then it's in your face and you're like, oh, okay, all right. So it's
or Twitter. Now I guess nowadays social media is a bigger bigger factor.
Yeah, it is. It's a huge factor. So that's one factor that we're just talking about on a whole, the news and the narrative around a company. Because when those things change, stock prices, the price definitely also changes too. So you can see that, and we'll see what the next buyer will pay based on the news I don't know if you've ever heard the classic saying, buy the rumor, sell the news. So, prices rise into like an announcement and then cools after it was already expected. And the same thing happened with
the information parity thing.
And the same thing happened with Wigton though, because as you said, Wigton went as high as $1.50. I think it went even higher than that, like $1.60 and so on, off of just the news of them winning and them announcing that they won the bid and all of those kind of stuff. But where's Wigton now? Wigton has cooled down after all of that. Wigton, I think right now is trading at $1.22. Yeah. So just another, and nothing's really changed with the company, right? Well, I mean, I think they said they wanted to like they have to raise certain money, but we all kind of knew that they had to raise money to be able to do this whole build out. But I think nothing's really changed that much. So yeah,
like what I kind of thought about it, I was thinking about that with like neuroscience. You know that there is a chemical that's released in your brain, like it helps your nerves, basically help your nerves like communicate with each other, like dopamine. And dopamine, I think more dopamine is released in expectation of a reward. So you get more, like say you're going for cake, say you love chocolate cake. More dopamine is released leading up to the chocolate cake than when you actually get the chocolate cake. And I think that's kind of what explains the same phenomenon you're talking about, where the expectation of the event can cause a greater reaction than the actual event taking place.
They've done animal studies and so on. Yeah, it's all behavioral finance and neuroscience and
psychology
so on.
And stuff like that, which is what really drives the market, we're saying. Because I always sometimes you always have to go back and say, okay, yes, this company you might look at, the balance sheet this, or the profit is this, the cash is this, but you kind of always have to look back, as I said, like what really moves the price.
Yeah.
Okay, because the good thing could happen that you expect, but if people don't care about it or know about it, and enough people don't care about it, or if there isn't something to cause enough increase in the demand to match the supply, like basically say there's something gonna increase the supply, that there's a big seller coming in, like at the same, like I remember, there's lots of different times where like, something you expected a price to move more, but then say at the time when the information came out that made people rush the stock, a huge seller just jumps in. That can start the price, and you just have to know that. That's just how it works.
Funny. You can actually map out the dopamine surge in our brain, and it looks similar to like how certain stock prices look based on certain things, as you're saying. Because you're right, dopamine isn't necessarily the same as pleasure. People think it's the pleasure chemical and so on, but it's more, as you say, about anticipation. So in reality, dopamine fires, as you said, before the actual reward. So it's when you expect something good might happen. It's the brain's motivational signal, and it pushes you to like pursue like the reward or so on. So when you predict a positive outcome, like a stock going up, dopamine neurons, they fire. I think they fire somewhere in, I think it's the midbrain, but I could be wrong. And they increase firing. But when the reward comes, as you say, the dopamine only spikes if it's better than expected, right? But if it's worse than expected, dopamine drops. You feel disappointed, demotivated, and so on. But why that matters for investors, and bringing it back to the stock market, the stock market actually triggers those dopamine loops, because I don't know if I'll talk to the audience. I don't know if you guys have ever seen like a green day on your portfolio. Your portfolio gone up, and that's reward. But hearing earnings are coming next week, that leads you to anticipation. Because let's say you own a stock and you're expecting good rewards, right? And earnings coming next week, earnings season is coming up. That's increased anticipation. So your dopamine surges. And then you start checking your phone, you check the stock prices, you keep checking the stock prices. Over time, people actually chase that anticipation and not necessarily the rational outcome. And it's why people trade often. And that's why FOMO into hype happens, and certain things like that happen, or people check their apps compulsively and so on. But I remember, I think we did an episode on this, but there is a whole effect called the prediction error effect, where the brain, it's like it updates like the dopamine signals based on the surprise, right? And I'll explain. So it's a gap between expectation and result. And so when it's better than expected, dopamine increases, it reinforces the behavior and so on. If it's expected, there's no change, and if it's worse than expected, it drops. So in markets, let me give you an example, and this is tying it back into the same factors. Let's say the company reports record profits and so on, right? This could be record, and we see this happening sometimes. A company will drop banger profits one quarter, banger profits the next quarter, and so on. But if investors actually expect even more profits, prices can actually fall. And you'll see that sometimes where a company will release good profits, but the prices don't actually jump like that. They may stagnate, they may fall. And so dopamine works in the same way. It's about relative surprise. It's based on people's expectation, not results. So that's another thing I look at with stock prices, because profits. People say, profits go and move the stock price because profits go to change the PE and with the disvaluation and so on the company and blah blah blah. But sometimes it doesn't really matter. A company could be making profits and you'll see it. There are tons of examples. I don't know if you can find any on the market, but there are tons of examples where companies are increasing their profits regularly and the stock price doesn't really move.
And I found the neuroscience thing we're talking about.
Oh yeah.
So this is supposed to be a graphic. There was this scientist Robert Sapolsky. So he's actually apparently he was doing some stuff with monkeys, if I'm understanding this right. So this is the dopamine chart. The y-axis is dopamine. The x-axis is, I guess, time. So he showed them a signal, which was a light. So the light would flash, and then when the light flashed, there was a button they could press. If they pressed the button 10 times, they would get a reward, which was some candy or some food or something. And he's saying that, and the word, so it's like the signal, I don't know if I guess to tie this back to stocks, the signal would be the positive news possibly coming out. So the stock price is rising in relation to the positive news or the expectation, like maybe a good report comes out.
No, the report doesn't come out yet.
No. Wait. What I was thinking about is
expect a good report.
No, well, okay, I'll give you a certain example. So one example, good report comes out, but there is, in the report, they speak about possibly increasing the profits even more. So it's like, bam, there's a sign that, hey, things are good and we are expecting even more because of this, because of that. So there's expectation after that say, hey, good report has come out. We're expecting even more. So the stock price rises. And then the work in this one, which is when the monkeys actually press the button, which would be, I guess, the reports coming out. By that time, the stock price has now started kind of coming down. Or I guess the stock price would be more, I guess the report coming out would be more here, but
yeah,
I guess that's
what I'm saying, right there. The signal is the expectation. When the stock price actually comes out, dopamine has already kind of fallen, and then you see work versus reward. I think work is where the stock price, the report actually comes out, and reward is,
or the other positive news, I guess, not just reports or something,
Yeah. And I mean, I feel the same thing happens for that whole category. I would call it like company results and plans ish,
because it's news.
Or positive, yeah, because it could be.
It's not necessarily about the company specifically, because it could be something in the industry that people then tie back.
Well, no. My point is the company. This factor for me is the company, because the industries are different factor for me. But for this one, it's more things like earnings, as we spoke about. Could be dividends too, as well. I think dividends and earnings can be similar. It could be things like, I don't know, buybacks. Buybacks are also a factor for the company as well. Them raising money. We've seen how APOs and rights issues can also influence stock prices and so on. Maybe even acquisitions and mergers and stuff. And even things within the company, like let's say they want to create a new product, or you said Transjam acquiring a new highway, right? Or let's say they were going to offer a new revenue source
branch.
or line, exactly, or a new arm, or
Acquisition,
leadership change.
all kind of
Imagine
stuff.
if somebody, you see a big leader take over a company, and like somebody that's done. Imagine if you saw a man like Kadeen Mears, and you hear say he's the new CEO of like ISP, right? Bro,
I thought you say access. I thought you say access.
Or access. Imagine you hear him take over access, bro. You don't think that stock price would fly? Please. So like there's certain things that that in terms of the company itself, whether it's results, whether it's plans, whatever changes in the company also can drive prices, whether up or down. So that was my second point. The first one we spoke about was the news and like the narrative, but the second one, company results for sure also can move it. But it's just to bear in mind that whole dopamine effect. Funny how we're bringing neuroscience and things like that into stocks. And people say finance and medicine don't mix. Would you look at that? But you spoke about the industry itself, right? Like the sector, the macroeconomics. I don't know if you wanted to touch on like how on that kind of stuff.
I was just thinking like, say there's like a tax, like say our industry was taxed very heavily, like say it was a 30% tax, and now there's an announcement that hey, the government is going to be reducing that tax. I remember like in tropical battery a few years ago, there were some good like changes in the initiatives in the, I think, budget debate or something like that. Like, oh, they were gonna announce the reduction in this GCT or reduction in this. So like it could be a change that the government is trying to help a company more.
Yeah.
And it could be a positive change. And then once again, information starts to come out, it's spread, it comes into articles, taking stock, whatever. People then view the company differently. People then want to buy the shares more, or maybe sell the shares more, whatever, depending on what the news is.
That's very true. Like even chickens, and how there's a huge, like it's a string of taxes or so on chicken, like tariffs, so that our local. I told you I spoke to Lisa Hanno. I told you I spoke to Lisa Hanno last week. We literally spoke about all of that kind of stuff. It was a very decent conversation. Lisa, I hope you're listening, because I pitched the podcast to her. But she really dropped some very good points on the chicken tariffs and so on, and I guess the duopoly of CB and Jamaica broilers and so on. And we had a decent chat. I hope she comes on the podcast one day. Guys, comment Lisa Hanna down below if you want her on the podcast. But let's see. But I agree. If there, a policy change can reprice an entire sector even overnight. So yeah, I think even energy as well, right? Because oil, if oil spikes or oil starts going up, you see certain industries, manufacturing, etc., those that are heavily reliant on those kind of things, those prices start to fall. So yeah, I agree. And we don't even get into things like inflation or interest rates or the foreign exchange and all of those kind of stuff.
I mean, as I said, the same concept I was saying of information and then perception and behavior, it follows the same thing. So you could apply it to that too. Some information comes out, it changes how people view something. Maybe it doesn't actually change the thing, but if it changes how people think it is, the stock price don't care. That's like you could be like, yo, this don't make, like, I mean, that's the benefit of the market, because you could look at something and say, hey, say it's some news that is like, the titles are bad. Like sometimes just the title of the news, like it could be something that's good, but just because maybe the title or the wording of it seems bad, or people think it's bad for the company, once again, the perception, they then say they want to sell the stock dumps, but you look at it and you're like, no, but that's actually a good thing, and then you can buy. That's
Are you thinking
market.
of a particular stock? That sounds like Dolphin Cove to me.
Yeah, I guess Dolphin Cove and their parent company
going bankrupt. To me, that sounds just like that, because I mean, there is no reason to sell that stock just because the parent company is bankrupt.
Tell that to the people that sold, bro. If you see a headline, once again, as I said, the headline. I don't remember what the headline said, but if sometimes, and then even like once, you don't even have to remember. There's like different levels. Like some people will read the article, some people will read the headline, some people only read it maybe like a 1 or 2 words in the headline. Some people may just read what someone puts on TikTok of the headline.
They'll see Dolphin Cove.
It's like a Chinese telephone come back again. So if you just say, something bankrupt, you see the stock price dropping, your emotions are running wild, that it's perfectly logical to you to sell. Commit. What if you bought the shares at $5? It's now at $15 for you. You're selling at a nice gain. So that's just how it works.
That's very true. Very, very true.
Yeah.
I think for the last factor I want to talk about is big money flows and mechanics. When you say the big money man, the big money pension funds or so on, or whatever funds, right? Whether they add or remove a stock, they rebalance their portfolios. When you see them buying or selling, or even not just that, them, but I'm thinking insiders as well. You'll see directors of a company buying or so on, and you'll see them buying heavily. You see big block trades. I think those things also definitely move stock prices. Those are things I always look for. And we always look to see, and we say it sometimes, like, who's in the driver's seat? Like, who is really driving this stock, right? Who has a vested interest in this stock, right? And in the price going up. I think those are things that also, or going down. I don't know if anyone has a vested interest in it going down, but hey, we've seen the one thing that always kills me, and for not a good reason, is carb cement. And when carb cement, the parent company, they basically are majority shareholders, so they're the ones that voted that they will get a royalty, meaning if whatever money carb cement makes, a percentage goes to the parent company off of just the revenue line. So the top line, the revenue line, no matter what happens, they could be losing money or so on, doesn't matter, the parent company will get money. And they voted on it because they're a majority shareholder, and of course it passed because they're a majority shareholder. And then you see Mayberry said, I don't rate this, so I'm selling. And they dumped millions of units on the market, on the open market, and tanked that stock price. And so you always have to wonder who else is in the stock with you. And I don't wrong, Chris Berry for doing that. If it was me, I would do the same thing, because it sends a message to it feels bad because the retail shareholders may feel it. But at the same time, you kind of have to voice your opinion. And if you voice it at the AGM and them still take you for idiot, then you just don't want to be a part of the company anymore. And that is valid. It's your choice. If you don't believe in the direction of the ownership and so on, then just sell. It has, of course, significant consequences, but I can't fault a man for selling because them do those kind of things. So hey, but it's always good to follow the big money, in my opinion, because you get to see you just get to see how the stock price will move, and it influences the stock price a bit more than just 1 or 2 retail shareholders with lower levels of money, like me and you. So yeah, I think those are the factors for me. I don't know if you have anything else you want to leave with the people.
No, I think that's yeah. Just go back, as I said, just to summarize. There's some sort of change in the information, which changes the people's perception of the company. So the value, how they viewed it, they were like, hey, I think it's a $10 stock. Well, they thought it was a $10 stock before. Now they think it's a $20 stock, or now they think it's a $5 stock because of the information, how they interpreted it. It's not maybe what the actual information actually says, it's just how you interpret it. And then it changes your behavior. You want to buy the company more or sell the company more. And yeah, at the end of the day, that's really what moves the stock price. It's not just because they made profit,
Yeah. Yeah, bro. I agree. I think we hit quite a few different points. Guys, if you think we're missing any of the factors that move money, comment please below. We want to see, so we can discuss it maybe at another episode or so on. But comment below. We'd love to see what you guys have to say. If you like this kind of video, please like, share, and subscribe. Smash that notification bell because we drop episodes every single Friday. Thank you guys so much for being here, and like always, stay limitless. Out.
Peace.